Hey guys, welcome to Elite Acquisitions and Investment Banking. We're here with Samuel Lisk, aka Captain America, who also has an MBA in finance, and we're going to be discussing stock investing and valuations. You guys know there's a lot of misconceptions and a lot of people sharing information regarding stock investing. So we're coming here with somebody who's actually investing and has a pretty good portfolio to discuss how he looks at their stocks. Sam, glad to have you on, brother.
Appreciate you,
What's
man. Appreciate you being here.
what's up, guys? Glad to be on here. Glad to help out some individuals. First off, I want to start off with just a disclaimer. Obviously, to make everyone aware, I am not your investment banker. I am not your financial advisor, anything like that. Do not get confused. What I'm going to be talking about today is long-term investing for a defensive, like we are setting up like generational welfare or wealth. I'm not talking about day trades. I'm not talking about like crypto. I'm not talking about any of those things. I am going to help you set up a portfolio or give you the criteria that I use to set up a long-term portfolio that's going to make you well off 5, 10, 20 years and so on and so forth. So that one, you are hedged against, again, the market and the volatility of it, and make sure that you're making at least on a passive side without too much intricacy, going in and actually like getting into the global economics, getting into the deep dives, doing a lot of the evaluations, the things that your hedge fund managers, everything like that. We're going to be doing something, and it's going to be from the perspective of a defensive investor that's going to get you at least, if you really put just a minimum of about an hour and a half to 2 hours max a week, you're probably making 16 to 20%, if not around 30% rate of return annually.
Wow, that's bees. What's the standard? Between 5 to 7%?
Yeah. Yep.
That's crazy. So tell us, Sam, what interested you in getting into business, studying finance, getting your MBA?
So, originally, the reason I wanted to get into MBA is specifically because I started my undergrad with chemistry and mathematics. It's analytical. It's something that you can understand. And I was focusing in on trying to get into healthcare. I wanted to get into that basically so that I wanted to be able to understand the businesses and the faults of healthcare itself. And I thought I could do that from the physician side, but I fell in love as I continued to advance my career into the actual business and finding and specializing in both like healthcare and business type finances, and then reviewing and just really getting into a deep dive of all that stuff.
Perfect. I got this saying, I don't know how true it is, but I say stocks, the way you make money on stocks is based on basically assumptions of things that could happen with the company, either growth, new contracts, things you see in the news. That definitely affects the stock price. Whilst with crypto, is mostly on volatility. How much would you agree on that?
I highly, yes. So when I look at stocks, there's a lot of different ways that people evaluate stocks. I am a big supporter of Benjamin Graham and his intelligent investing style, and I have the criteria here along with what I do, and I can get into that. But it is like you can look at stocks and you can look at the volume, and you can trade based off of the volume. You can do something called like foreign exchange. Like you're trading currencies because you believe like the dollar is going to, because of inflation, the dollar is going to go down in evaluation, and maybe the franc or the euro is going to go up, and then you play on that stock market. There's so many different ways of how you can evaluate both stocks, or how you can create a strategy. And the biggest thing that you need to be doing and reviewing yourself is, again, stocks are volatile. Things happen all the time. It does not matter the market. What you need to focus on, if you're, again, with this concept of being a defensive investor, is how is the best way I can hedge against any type of volatility while growing at a steady pace and ignore all the noise.
Great. Now, you know about beta, right? Beta goes from 0 to 2. Anything under 1 means the company's volatility is less than the market's. It's more stable. On one is basically on par with the economy's volatility, and over one means that it's more volatile than the economy. Now, they say the higher returns are with betas over one, as is more volatile. Lower returns are betas under one. The major difference between them, though, is the risk. Anything under one is more of a long-term play, your 6-7% return, steady, is a secure stock, the company is strong, it's stable. Anything over one, you're going to get those higher returns, but now you're risking more. What do you look at?
So, all right. So I'm going to go into, so I don't really evaluate the beta because again, this is a lot of, yeah, you're checking the market against the market itself. The way I do it is, like I said before, I really focus in, and I'm a really big follower of Benjamin Graham's Intelligent Investor. And what that means and what his style is something called value marking or valuing a stock. So like, for example, let's say you know a car, you understand a car, you have a concept of how much a car is worth, all right? You've been shopping around for cars, whatever. So you have a good idea how much a car is worth, whatever model it is. So let's say you know that, for example, just like a Lambo is worth, like a 2005 Lambo at 30,000 miles driven or whatever is worth $100,000. I don't care. It doesn't really matter. It's just an example. So you know that this car is worth $100,000 and you show up at the dealership and the dealer comes to you and says, hey, I'll sell you this car for $160,000. You're going to pass on that, right? Because you know that that car is worth $100,000. And if a dealer was trying to sell you for 160, that car is overpriced at 100 by $60,000. So let's say you keep doing this, and because that's the concept of stock. You should know the stocks that you're getting into about what their average is, what their evaluation can be within the 16 to 18 month mark, or have a good idea. I'm going to break all of my criteria down, but just for the example or whatever, you should understand what business you're getting into so you know about how much that share is worth so that when it's underpriced, you buy it, and when it's overpriced, you sell it. That's how I view this. Now, to get into how I see if that share is underpriced or overpriced, I go by these credentials. I'm just going to lay it out, right? So first, I look at the business and the most important part of the business, who is the leading, the spear tip, the CEO. I want to know if I'm interested in buying shares of this company, was the CEO's vision, was the CEO's track record? Has he been known for growing companies? Is he effective? Does he have a vision? For example, let's use the most famous one out there, Elon Musk. I believe, and again, do your own research, all that. I'm not your advice. I would not be surprised by 2025 that Tesla becomes similar to Google and that he is looking at a share price of about $1,500 around that time in about 5 years. The reason for this being, and before I get into the evaluations, is because one, he has a massive history of growing companies, PayPal, for example. You can see how fast he grew his share price of Tesla. And then he wants to go, he has these massive dreams. So he's not going to be running his company just to get that steady growth every year and just stay with the status quo. He has massive goals and aspirations, and he believes in them. So first off, if you're going to get into shares and you want to know a company, you need to know, hey, is the CEO just doing, do they have any really strong principles and values that are going to grow the company, and have they demonstrated that they're capable of doing it in the past? Second, is there a need for the products and services, and is that need going to grow just based off of logic in the next 5 years? Technology is huge. EV, so electric vehicles, are huge. They're look in sectors that you believe that they're going to be here at least 5 more years, and the dependency on them is going to grow and grow and grow. This could be the logistics of Uber. This could be the logistics of, for example, one of the stocks that I won really big on was Snapchat. I saw Snapchat. I saw that their CEO did not cave to Facebook originally because they wanted to continue to grow the company, and that the reason that they weren't at the current valuation was because, and I bought in when it was about $6 a share, because they had not monetized and they were not cash flowing yet. When I saw that, I jumped on it because it was just like, this is going to grow. This is going to be a competitor for Instagram and Facebook. And they haven't really, and there's a chance that there's a merger because Facebook's already looking at them. And that's just something, again, you just listen to the news about an hour to 2 hours in your specific areas of interest. So you find companies that you like. And again, CEOs is a major point. And then there are two aspects that everyone should know about stocks. There are analytics, which again, this is going to go into your formulas. This is going to be like, and you can find out there just how to evaluate stocks, how to like look at stocks, all those things. And they will create formulas every day. And those formulas are really good. And you'll usually like, it will be like nothing will, the only thing that will detract from those formulas are like the major like instances or crises, etc. Like maybe a government comes out with some kind of new legislation that screws you over. Maybe there's a catastrophe, like for example, the pandemic for Corona, and that just sunk the market during that time. You can't really judge that. And these formulas are going to probably get like, they're going to get you a good return, right? But what you want to play on is the second aspect, which is emotion. Everyone has emotions, and people get emotional when they deal with stocks. When there is a panic sell, you want to see, like, I love to see in the market red, especially with the companies that I'm investing in that I know within the next 6 to 18 months, I'm looking at a 15 to a 25% rate of return, and I see a dive during that day for like 8%, 9%, 20%, whatever. I love seeing that red because I'm instantly going to jump on it. I'm going to buy more shares instantly. Because again, if you know the value of a stock to be $20 or $10 or whatever, and it goes down from $10 to $6, then you can buy in and you're going to make $4 per share price because you know the value of that stock and you bought in when it sank. So I love seeing red markets because I'm going to buy those shares with my I'll save capital for what I'm going to invest in. I'll buy those shares up, and that's going to reduce the cost per share the average cost per share that I have. And I'm going to sell out when I reach the goal per share, or the value that I was angling for per share.
Hey, look, real quick, Sam. Now, just to touch back on, the famous example that you just made, Elon Musk, and I just wanted to, I guess, ask a question or maybe get your perspective on this. When you look at a company, now obviously Tesla, they just had AI Day, introducing this robot. How do you feel about that robot being added as a product line to Tesla? Obviously, that's something they're using to generate more, revenue, and maybe dumping it into SpaceX, something like that, But how do you feel about companies that add multiple products? Maybe they add 2 products every 2 years or so, versus companies who they don't really add products, but they have a steady growth rate with the same product and the same customer base, and it's strong. So how do you feel about investing in either company? A company that, they always keeping things fresh and innovative, like Tesla, for example, is always something crazy with the Cybertruck, which the Cybertruck added, to the company's value. Now this robot, do you think this robot is going to add a lot to the company? And how do you feel about investing in companies that doesn't really offer products, additional products throughout the year?
Yeah, like Coca-Cola and everything that just keeps
Yeah,
that status
exactly.
low. Okay.
Right.
All right. So perfect. So that's what I was going to get into. And I have the 7 rules again that I'm going like we can go into right now because that's perfect. That really leads well into this next point, which is again, hedge your volatility and ensure that you have a good base for the companies that are going to have that steady product flow that that they're going to be accountable like each year. And then always have, and usually it depends. I'm going to get into this rule, how much you're willing to take in volatility. And then you love to see those companies, especially with innovators and CEOs that have shown that they are competent in what they do. So let's get into those rules really fast. So usually everyone knows that has been dealing with stocks, diversify. However, usually, and in the intelligent investor, usually they do 10 to 30 companies. All right, maybe you don't want to take into that consideration. So I would say that the next best thing for 10 to 30 companies, if you're going to create a portfolio of 10 to 30 companies that you want to do, I would have a large amount, or at least 40 to 50-ish% in index funds and ETFs. Now, what is an index fund? What is an ETF? And people hear mutual funds, and we can get into that. So an index fund is basically a stock that is created that, again, takes out someone that is like an analyst or anything, and is just like created from, like, you hear the S&P 500. So it's a share value of that stock, or a percentage of that stock is the top 500 companies. But the entire stock itself is made up of how well the top 500 companies are. All right. The same thing with exchange trade funds. So index funds are in like a Roth IRA, while you have your ETFs, which again, though, and that's kind of like the bastardization. So now, instead of having a stock that's in your Roth IRA that's made up of a lot of different companies, now you have something that's openly able to be traded on the market. Okay. So for example, an ETF would be an index fund, except instead of pulling out of a Roth IRA or a retirement account and getting penalized for that, it's openly sold, kind of like Facebook, Google, etc. But it's made of those. It's still made up of like the Fortune 500 companies, or you can have a large cap or a mid cap or a small cap type of index fund, which is just looking at certain companies. Like you could get into a technology index fund. So it's the top 500 companies in that technology field, and it's combined to reduce the chance of any type of volatility, because you have such a diversified account that the really good earners for that day and the really bad earners for that day are going to offset each other. Index funds and ETFs, they usually earned steadily 8 to 14% just annually. Okay. In fact, ETFs and index funds actually outperformed the large hedge funds over a 10-year period. In fact, Benjamin Graham literally had a $1 million bet with, I want to say it was Blackwater, which was one of the hedge funds, that his portfolio of straight index funds would outdo their analysts on an average rate of return and stuff. And Benjamin Graham literally won this. It was a 10-year bet, and Benjamin Graham won. And that's just going to show, like, you don't have to spend an enormous amount of time to at least get a 8 to 14% rate of return annually. Like, if you wanted to, you could just put all of your money into 3 or 4 really good index funds that have a really good track record, and you're gonna have a really set foundation. Okay, so I always go for, have about 40-ish to 50-ish% of your fund into an ETF, in ETFs, index funds, etc., so that you are, again, hedging against any type of volatility. Like Anzi just said, for companies that are trying to advance the bleeding edge of technology, etc., that, sure, maybe maybe that adds to the company. Like, that robot may do something amazing. What happens if you find out that the robot is absolute garbage, that they just wasted their entire R&D research fund on creating this robot? It did absolutely nothing, and now they've gone red in the revenue streams, etc., over this last year, and they have to liquidate that, and it slowed down their progress, and they lose 20% of their stock price. Like, what happens when a company that you don't even know tries to do some kind of R&D, and they're not Elon Musk, they're some Joe Smo that you're trying to be greedy with, that they don't have a reputation yet, and it crashes and burns around you. Like, I always say hedge your bets, and I hedge my bets with ETFs and index funds. That's what I do. The next thing is, and here's a really good strategy that a lot of people do. It's usually I'm sure that if you're in the finance space, you've heard of this, which is take your age and subtract it from 100, which is, so for example, if you're 30, you have 30-70. So 70% of your investments are in stocks and shares, and 30% of your investment are in bonds. So again, bonds are basically the guaranteed or backed by the maybe America, or basically they're backed by either business or government to be paid back. So they're very, very low volatility, but there's very, very small gain on these bonds. So they're going to be worth something, but there's not much room for growth. It's just making sure that you stay on the status quo, and that's one of the famous investing prices. So the second criteria, after you get through the diversification and basically hedging against any type of this volatility, is you're looking for those large successful companies, usually blue chip companies. All right. So Benjamin Graham suggests someone that's doing about $700 million in sales annually. I usually do, like, that's a lot. So I can cut it down, and if I'm interested in it, I do something about 500 million in sales, and I use tip ranks for this. And if you're tip ranks, Motley Crue and Morningstar are the big financial news outlets that I use to review stocks, etc. And they have a lot of great tools. Again, this is not sponsored by any of them. I'm not sponsored by any of them. These are just the services that I use to make really good and well-informed decisions on share prices. And I either go to about 500 to 700 million in shares, but the big thing is I will look and grade these shares from D to, like, I'm not going to touch the stock, there's too much volatility, to A plus, like it's a blue chip stock, it's steady, it's going to be good, there's growth, there's a lot of potential for it. And I do that by looking at tip ranks, and they have usually analysts that do a deep dive on that and then give it a score of 1 to 10. And then I just say 10 is 100% and 0 is -%. So I'm looking for at least an 80 to an 8.5 ranking on that. Oregon sales are about 500 to 700 million a year. And then obviously the CEO test, I said, like, is their product or service going to be needed 5 to 10 years now? And is that necessity and reliability on that product or service going to grow over the next 5 to 10 years? Then we go into, again, number 3, which is you should be looking, and usually you can even see this on Morningstar, so you don't actually have to do the financial analysis and go into their financial reports. 1.5 to 2 times their assets versus their liabilities. So what does this mean? You should have 1.5, and specifically liquidable. So you can say that, again, and if you get into the deep weeds, and I know if you've been following Ansi and Valentino for a little bit, that if you get in the weeds on this thing, you can find assets that don't mean jack crap. Like, they have assets that are literally just, hey, their slogan or something like that, like an intellectual property that doesn't mean anything. When you're looking at assets versus liabilities, you are looking for 1.5 to 2 times the liquidable assets. So property, inventories, any type, maybe trademarks, things that actually have ground in, like, they're actually there, that you can be scrapped if everything goes off, compared to liabilities, so their debts, etc. So that's criteria number 3. So that they're in a strong financial part. They have not missed a dividend payout in 5 years. If they're doing dividends to their shareholders, you need to see if they are paying out dividends. Because basically what this says is, maybe there's been some, and anyone in the finance world can, and I guarantee Valentino and Anzi can go into this, they can show you on the balance sheets and on their cash flow sheets where basically they're over evaluating, or they're fluffing up one of their ratios so that it looks like a strong financial, like, entity, or that they're in a good position, and you find out that they've either done a tax write-off, or they're blowing smoke up your ass, or they've manipulated one of their numbers. One of the big things, if they are paying dividends out, and they're doing it consistently, and it's been growing, or at least it stayed steady, then you know that they're in a good financial and a good reliable state, and that's good. If you say that, if you look at their, like, P/E ratio, which we're going to get into just a little bit later, and they have it, and it looks good, but then you find out that they're not really doing well on dividends, there's something there. be careful. So that goes into the dividends. 5, there has been no earning deficits within the last 5 years. So that basically means, like, regarding the pandemic, no one could have seen that coming. But like, if the business went a negative worth of sales within a few years, that might be a sign of decline. Okay, like if they aren't constantly at least keeping with the status quo, you might be looking at a decline. So AMC, before crazy Wall Street bets and all that shit, like you could have seen that coming because everyone was moving towards Netflix, and when Netflix, then you had Hulu pop up, now Peacock, and you can see where the market's going and everything, and people are getting far away from the original, I'm going to take my date out to a movie type of deal, which is sad, but at the same time, unless like the CEO came out and said, we're going to create a streaming service or something like that, or we need to create something to be competitive, you can see that their earnings started to go down, and you would have lost money because you'd start paying the price of, what is it? Whatever. I'll get back into that as soon as it pops in my mind, but opportunity cost, because you can't invest those funds and it started to go down, and now you're just waiting for something that could go bankrupt and dissolve, etc. So you don't want to invest in anything that has an earning deficit, and then you are looking for a company that within the last 3 to 5 years you have seen a 6% to an 8% growth, or if they've existed longer than that, 20 years, you're looking for an average 3% growth rate. Okay, which basically means and that's really simple. You just see where the shares are or how the price of the share from 1 year to the next did it increase by like 6 to 8%. Like, and that just keeps you with that, again, steady flow if you're trying to hedge against bets or hedge against any type of volatility. And also, it's going to at least incentivize, even if it's a bad year or something, for something that a company like Tesla, that they're going to do or have a good earning overall in the long term. Again, I'm not talking about day trading here. I'm not talking about trading crypto. I am giving you guys the foundation for having a solid portfolio that the more work you put into it, yeah, maybe you can get the 35, 40, like the extreme crazy amounts, but I'm not going to promise, like, this isn't hey, I'm going to make $1,000 in a day, like get rich quick scheme. This is to create a solid portfolio, a backing for your future that is going to leave you well off no matter what you do, and it's something that's very simple that you could even automate. And then the final criteria, the final 2 pieces of criteria is, hey, they have cheap assets, and that's basically the market cap is less than the tangible assets versus liability times 1.2 or 1.5, which basically what that means is you are trying to see the market share, and you can see this usually in tip ranks for, again, cheap assets. You're looking at if you're buying stock, the stock price is not over evaluated. And again, that goes into everything else. You just want to make sure that the price you are buying these shares at is not over evaluated. And then, and then you look at the P to E ratio, which is price to earnings ratio, and then that's less than 15. Again, just to ensure that your assets or your share prices are not like overvalued at that point. And that's really how I really interpret all my stocks.
Hey,
and
look,
yeah,
sorry about that. Real quick, right? Just going back to something you mentioned earlier about the bonds is very little return. Well, okay, yep. So we all know, and for those who don't know, me and Valentino, we're more so into mergers and acquisitions, and that's alternative investments, right? And it tends to have higher returns for investors, but when you're talking about stocks, bonds, and stuff like that, real estate, equity, those tend to be lower returns, around what you mentioned, 10, 12, 14, 15% returns. Now, bonds, they're slightly lower returns. Now, I just have to ask, the bonds, they have very low return. Is that why you have such a low risk-free rate? Because you get your risk-free rate from the 30-year T-bond, right? And
Yeah, basically.
right. So is that why it's so low, the risk-free rate associated with when you're valuing the company? Obviously, you take into account the risk free rate. You have to calculate that. Well, if you calculate that, but is that why the risk-free rate is so low? Like what, 3%, 2%, 5%? Obviously, throughout the years it changes. But is it because it's government backed? Is very little risk involved? Is that why it's so
Yes.
low?
That is that, and we can go, and I'd have to do some more because I really don't really care for bonds because of how
Hmm.
absolutely just, again, the rate, like it's literally bonds make sure that you don't lose money to inflation, truly. Like that's what they usually do. They hedge against, and they make sure that you aren't losing money towards inflation, really. Um, I would have to go and do, because again, bond rates, the interest rates increase and decrease with government needs and basically their debts. Because obviously, if you own a lot of U.S. bonds and the bond inflate, like the U.S. is pumping out money, then the bond rates, like the interest rates, start to increase or decrease with how healthy the government is, because the government has to back those bonds at the end. So again, I would have to dive a little bit deeper into bonds, and I could probably do another podcast after I do some more research on bonds, but I usually just stay away from bonds because I find that you will make a lot more money just with stock itself and shares than you will with bonds. Now,
No, of
don't get me
course.
wrong, you could definitely, if you know what you're doing with bonds and how to leverage them, like there is very good opportunities there. Don't get me wrong. Again, like I said, one of the most agreed upon, like the, I guess the average wisdom that I think got famous. I can't remember who pushed it. It could have been not could have been Warren Buffett. I can't remember if it was Warren Buffett. But basically, it was the take your age, subtract that from 100, and then that's the percentage you need to be into bonds versus shares of stock. Again,
Mhm.
to reduce the liabilities of some kind of volatility or reduce volatility, and downplay your risk.
Now,
All right, cool. Let me hop in with a couple questions.
Go
yeah,
for
go
it.
ahead.
All right, so what is hedging for those that don't know?
So hedging is basically when you have a good set of shares or stock that is going to reduce your risk overall. So let's say that you buy a high volatility stock that you don't know, it could go up like 30% in a day, it could go down 30% in a day. It is where you could win a lot, like get a lot of money or lose a lot of money. So you hedge and you buy something that, like Coca-Cola, or again a maybe an ETF or something that has an average rate of return that is not going to increase and give you a 3,000 fold payout, but you're not going to lose money. Like over time, it just does not happen. So let's say that you've bought an ETF, and that is worth that ETF is a certain percentage of your portfolio, and then you do some speculative research and you buy into a company. Well, let's say in the day that you bought into the speculative company, they declare bankruptcy and their stock, or not bankruptcy, but one of their departments goes under, the CEO is in a car accident, some massive issue befalls the company, and their share price goes from $20 to like $15, right? So you just lost a quarter. So you're down 25% of all the money that you had in. Now you say that, and let's say like it can continue to go down, but you're hedging against that because you have an ETF. So that ETF on a good day, it went up 8%. So overall, instead of being down by 25%, you're down 17%, because in the hedge slash the ETF that has a average rate of return or a good percentage or a good track record, that's always going to be that 8 to 12%, and that has very low volatility and everything. It has taken some of your loss. It's offset the loss from that super volatile stock. And that's what hedging is. You are reducing your overall risk because you have something that's like a blue chip or a company that has shown that it's diversified or that it will always exist and it has shown year over year to always grow a certain percent. And that takes away from the chances that you lose money overall in your entire portfolio.
Well, it was very in depth. I appreciate it. Now, do I need to understand the industry I'm looking to invest in?
So it depends on how deep you want to get into bonds. Again, like I said earlier, Warren Buffett literally got in a bet with the largest hedge fund on Wall Street and said, "Hey, my index funds, my portfolio of like 3 index funds of like the S&P 500 will outperform you over the next 10 years." And guess what? It fucking did. So literally purchasing, like, I think he purchased like 3 index funds and he just pumped money into that, outperformed people who were actively buying stocks, shares, bonds, etc. Like actively, like delving deep into doing all the research, the government, because the government, like everything you think of a hedge fund manager, of like deep diving, doing all this research, like 8 to 15 hours a day, etc., to get a share at the best price and then sell it at the best price, was outdone over 10 years with just index funds and just done with like ETFs. Like if you were okay with setting up just getting about 15 to like 15% rate of return, like 8 to 15% rate of return, and you don't want to do any work at all, I currently, again, I'm not sponsored by them. I use Fidelity, and because they have some of the best track records with their index funds. And I got into Vanguard for my ETFs. And it's just a steady rate, and all you have to do is just invest. Like you could just not standardize it, but basically just make so that every month or every year, whatever, you put a certain percentage of your paycheck, so salary in it, and you just sit it and forget it. And you'll earn about the 8 to 14%, 8 being on a very, very, very bad year. You'll still go up, and 14. In fact, during the pandemic, I think they still had, if I reviewed it right, like a 9% rate of return. And that's a bad freaking year.
During
They
the
still
pandemic?
did better.
Wow.
Yeah, they still index funds, and ETFs have shown to outperform 95% of the average Joe trading. The 5% that beat index funds are the ones that are working and getting scouted by hedge funds, and they're on Wall Street.
Wow. So I would be the best bet for the average person looking to save their money, invest it, and get a nice return year on year, right?
Yes, yeah, and that's if you don't want to be an aggressive investor. That's if you just want to sit and forget. You don't want to do any work. You don't want to do any research. You want to grow your
Straight
wealth
passive.
at a yep, just straight passive income. It's super freaking easy. I mean, it is just absolutely. It's so easy to do. And some of those, in fact, I'm pretty sure Vu does. But some of those actually offer dividends. So after every quarter, you get paid for a percentage that you have in those shares. You're actually going to get paid, and that becomes another passive income, along with those shares increasing in price. So you can sell it and liquidate it at any time you want. So it's a steady
That is beautiful.
way of just absolutely making, like, just brain dead, no requirements to analyze it, etc. Again,
Nothing.
this is for a long-term investment. If you want to get into day trading, that is a whole hell of a different story, and
So
that's something in far time.
would you suggest that road to be, say, 20 years old, straight out of college? You know, I got a nice low $50,000-$60,000 salary a year. I put away $500 a month, and I'm looking to have $1 million by when I'm 40, 50, 60.
Like 40.
Right?
Like, no, 40.
40?
Like 40. Yeah. Like
Not bad.
if you started at 20 and you averaged a rate of return by like 12%, just taking the in between a 14% rate of return and 8%, and all you did was do the like ETFs and just got that average rate of return that I was talking about with those cap funds, I would say it would take about 20ish years, and you'll be a multimillionaire just through investing like 500. And that's not even talking about the money you are literally making. Like, that's assuming that you continually just put in
Just the
$500 a
500.
month.
Right.
Yeah. But as you grow older, you're obviously going to make a shit ton more money than when you're 20 years old. So you
Right.
can start putting more money into it. And you can also, like, and another tip is, you can use that as you raise capital for something that you can invest in. So for example, let's say you're just doing that to guard against inflation, get 12 to 15% rate of return. So you're making money year on year. After 5 years, let's say you've saved up $100,000. Well, you have $100,000 that you can put as a down payment for a property. And let's say usually your down payment for a property is 10%. So you can literally use that $100,000 that you've been investing in growing year on year for the down payment of a $1 million piece of property after those 5 years. And you have someone, or you've built, or you have a tenant in, or you leverage that you can actually do a really good down payment. And instantly you have a $1 million asset piece of property that you can now use. And instantly you just grew from being worth a net of 100,000 to a net worth of basically $1 million, because you hopefully have a tenant or a business or something that's paying your rent, and you just have that cash flow constantly going to you. Or again, with the acquisitions, because we love acquisitions, you can use that as a down payment or as the capital so that you can acquire a business. Like, it's the exact same thing. It's all, you can do it either way and just restart. The best part, and this is what I want everyone, like, this is the most important part. If you don't want to get into that, if you don't want those risks that are associated with buying a piece of property or investing in a business, and you just want to, again, use that year over year, I highly suggest trying your best to know exactly how much you are spending every month, so that you can keep the bare minimum amount of money in a checking account as possible, and you can invest every other bit into some kind of stocks, shares, bonds, etc. Reason for that being, if you have $1,000 in your bank account, and in a year you have a 5 to 10, let's say 10% inflation, then that $1,000 in your bank account is now only able to buy $900 worth of whatever. If you keep a lot of your liquidity outside of that bank account and in stocks and shares and everything, and again, make sure that you have some kind of safety net, but somewhere that's easily liquidable, but is able to get more than just a savings account, which is losing to inflation. It allows you to beat inflation, and it lets you not take as much hit from just the government being government, inflation hitting, etc. It is going to grow with the economy or crash with the economy. Again, you have to assume that risk. That's why you hedge with ETFs, etc. That will usually year on year have about 8% rate of return, or you can put it in bonds. But you are guarding against your money losing value because of inflation. And you want to keep as minimal as possible in just a checking account, because you're going to lose money because of that.
Beautiful, man. 2 more questions, and let's kill it here. There's so much information. We're gonna have to do a part with you, brother.
Hey,
We're
real
gonna have to
quick.
do a part 2,
Hold on.
man.
Hey, before you ask the last 2 questions, I just want to touch on something real quick. The inflation rate. Now, I always say, if you're not making a minimum of 8% return on your money, you might as well just give up, because inflation is 2.3%. I just say that.
I think it's 5.5 right now, because
you know
fun
what?
fact.
Yes,
Yeah, fun fact.
you're right.
If
Holy
you haven't
crap.
been tracking the news, so I'll give this a little history, because again, this is the shit I love and do. So up until this past yearish, inflation was a steady, I think it was 1.1% annually. This year, in a lot of the areas, it has risen to about 5 to 5.5%, depending, again, statewide. Again, this is for USA, because of how much money they've been printing. It's highest it's been in 30 years. This beats the inflation of 2008 during the market crash.
And not only that, what percentage of, I mean, just with respect to the U.S., of course, what percentage of money that's in circulation right now was just printed in the last year alone?
Um,
Well, not
I
a.
have
You
to
don't have
check
to give
that.
a
Like,
specific. You don't have to give a specific,
I can
but
tell you the national
is it
debt. You
not
want me to tell you the
ridiculous?
national debt? You want me to
Yes.
tell you the national
Yeah.
debt?
Let's go. Let's.
27 trillion?
Yeah.
27 trillion.
Well,
So, and to give you an idea now, and here's the thing, I'll break this down. All right. So when I say 27 trillion, that just, when you think of that, it's so large, you can't comprehend it. So let's talk about actually how big $27 trillion is. It took Mr. Beast, and it doesn't matter, Mr. Beast, 40 hours to count to 100,000. Okay? 100,000. It took him 40 hours. So that means that if he continued on the average, it would take 400 hours, like 400 hours for them to count to a million. 27 trillion is 400. So 400 hours to count to a million. So that means 4,000 hours to get like it would take a lifetime for you, assuming that you were able to count from the beginning of your birth and every number you announced was 1 second line. It would take a lifetime for you to get to 1 trillion.
yeah. I mean,
You
I'm sorry, real quick, but I don't have the stats in front of me right now. But I mean, on average, we're born with only a few billion seconds anyway.
I want to say it was 27 billion, I think.
Yeah. So a trillion, you're talking about orders of magnitude above that.
It's absolutely insane.
We can't grasp that. No, it's just these are imaginary numbers to us, like literally.
Yeah, and the problem is, again, take this with how you will, but the percentage that we are paying in interest for that debt, it's getting I think it was 40% of the GDP. And I think it's growing in a percentage of how much we make. We have to pay down on the interest rates. So it's really leading to, like, either the government's going to have to raise taxes on everything and everyone, or it's going to create a hyperinflation.
So, great. Now, back to my original question, right? So we're at 5% inflation. Keep that in mind. Now, previously, before all this fiasco, this debacle, it's not political. We're not going to get into that. That being said, before this inflation rate was so high, I mean, if you're not making 7% return, 7% return on your money, I mean, what are you doing? Just give up. And I say that to say, how do you feel about, when people say, hey, just save your money, save your money? Me, I'm not a big save your money kind of guy. Obviously, you have something for rainy days, but you're losing money if you're saving money every year because of the inflation rate alone. We're not even including taxes or anything like that, just the inflation rate alone. And now it's 5%. How do you feel about when people say, hey, I have $100,000 saved in my account? How do you feel about that?
Cool. Yeah, you don't have $100,000 really. So again, this goes back into ETFs and everything, and keeping everything as less liquidable or as less in your checking account as possible. Usually what I've done is I basically have 1 month's salary / 1 month's worth of my expenses that I know that I spend every month, easy liquidable, in a account that is earning about 2 to 3%. So basically just keeping up with inflation, and that's my emergency fund. And then I have 6 months worth of expenses in ETFs at a minimum, because then if something goes insane or crazy, I have 6 months worth of expenses that are at least earning 8 to 14% rate of return. So that's my emergency fund, and then everything else is in index funds and speculations, and again, some other ETFs. So that even though on a rainy day, like, all of my capital is being leveraged to the best ability possible. I am not losing money. I'm not putting money into underneath my mattress or in a checking account or anything like that, other than, and this is why it is so important to establish a line of credit, because what I will do and what I suggest people do and how I handle it is I have a credit card or a credit or whatever you want to use with a certain limit. I will spend all of my money on that credit card for the entire month, so I know exactly how much I've spent on that month. And then I will put or I will pull or I will keep from my like both salary, consulting, everything. I will keep about that much money in my checking account with a good like $500 to $1,000 difference, just in case something hits that I'm not expecting or something like that, in my checking account. And then I will set it up so that the credit card pulls out after that month. So let's say that my expenses for 1 month are $5,000. Okay. Well, in my account, I'm not going to have $5,000. I'm going to pay, or I'm not going to have in my account $5,000 until I know the exact date I'm going to pay that $5,000. Then I pull it out, or I keep whatever I came or brought in through the month through my earnings and everything. I'll put it in the checking account. I'll subtract the $5,000 from it, and then let's say I put $6,000 in, or I keep $6,000 in because I know that I'm going to get charged for $5,000. They take out the $5,000, then I only have that little buffer, and all my other money, all the other finances I have are in my portfolio or being leveraged, so I'm making as much money as possible and not getting hit with inflation. I keep as minimal as you feel comfortable with in money in your account, and I would just use a line of credit for your expenses and make sure that you just have that money into your account and you deduct it after that month, and then you just know, and then you have a little buffer. That way, all of your money is being used to continue to make money.
That's what's up. Yo, let me get on penny stock exchanges. What are your opinions on them?
Penny stock exchanges,
Yeah.
unless you've mastered just this and you're earning a 20% rate of return on just the things that I just said, do not fucking do it. You'd be an idiot. You will get slaughtered.
Damn.
Penny stocks, here's the deal. If you're going to get into crypto, fine. If you're going to get into penny stocks, fine. If you're going to get to Forex, which is foreign exchange, fine. All of those are fine. If you want to get into it, go for it. That also means that, one, you best be spending at least 4 to 6 hours a day studying every fucking thing you can about that share, the world's global economy, anything that could impact it, etc. And you best have a business plan set up so that if you start losing money, you don't start pumping more money into it. You say, I'm going to make it. Otherwise, you're just gambling. You're just in a fucking casino. You're losing money. You're chasing bad money. Stop it. Until you can at least master. This is the most basic, like what I shared today is the most basic way to create a foundation of wealth that's not going to like lose you cash. As soon as you start doing speculations and stuff, if you don't have this stuff down, the hedge funds are going to slaughter you. Think about it. You are still competing in a market with people that all they do every day from 5 a.m. till midnight is evaluate all the balance sheet, the cash flow sheet, what's going on in the globe, the government. Is there has something gone this is how serious they are. Hedge funds will literally, if they have a company that they're investing in, for example, a freaking beef market for Sam's or Kroger's or something like that, they will find out and they will read the reports from the farmers on the weather, how big their cows are, the amount of grain that they've been using, the price of grain, everything. They will spend 12 hours a day focusing everything they can on a stock. Everything. And if you're trying to beat people that spend 12 to 16 crazy amounts of time investing every intricacy of a company, you are going to lose.
Damn, son.
Straight up.
Damn, son. That's hardcore. You heard it from the man. He got an MBA.
And if you want, if you want to do that, fine. But you will be if you're successful, you could probably go to the hedge fund and be like, "Here's my resume. This is my rate of return and stuff." Unless you are able to show an actual track record, again, like I said, index funds and index funds and ETFs from Benjamin Graham literally outpaced the best hedge fund on Wall Street. And index funds, mutual funds, and index funds, hedge fund, ETFs basically will outperform over 95% or around 95% of just the lone investor.
Wow.
So if you want to get in penny stocks, just know that if you're chasing after bad money and you're not willing to put in the work, you're going to get slaughtered by the hedge funds.
Damn. Hey, you heard it by the man himself, Captain America. I appreciate you, Sam, for being on this podcast. We're going to have to do a part 2. It's very extensive. Next episode, we'll have to compile questions from the viewers, though. So
Sure
it's
thing.
their questions. Now, wanted to say, guys, there's multiple ways of creating generational wealth. Either you're looking to buy a business and expand it, create a one-stop shop. You're looking to be an owner-operator and run your own business, start one. Or you're looking to take a simpler route and invest in current public companies. Definitely go with the ETFs. And what's the other one? ETFs and what, bro?
ETFs, index funds.
And index funds. And just put that money aside and let it pile up. Sam, thank you again. Ansel, you got any last comments, remarks?
Nah, no last comments or remarks. As always, appreciate the time, Sam. Definitely appreciate the time, and we definitely support you in your journey, man. You know that.
Let me know if for the next bit of go around, like what you guys want to know. Like I've been getting into crypto. I'm looking into day trading, things along those lines. What do the viewers want to see? And I'll research that.
Crypto. I can tell you
Crypto?
right
Yeah, crypto's a hot thing right now, man.
Crypto.
Yeah. So next episode is going to be on crypto, guys. Again, appreciate it. Go follow Captain America. Reach out to him. He got his own YouTube channel. We're going to put the link in the description. He has videos you need to watch if you haven't.
Yeah, I mean, it's Samuel Lisk on YouTube, correct?
Samuel J Lisk.
Samuel J Lisk.
Yep. And the big thing, we do business motivation and entertainment.
Beautiful.
Perfect.
Awesome. Thank you very much. Well, guys, catch you on the next episode. We're resuming podcasts, as you can see. We're looking to take a more steady approach. So hopefully catch us next week.